Hello class, in this video we're going to look at something called commercial damages. Now towards the end of this discussion the examples are going to get a little bit complicated, very detailed, so we'll have to really slow down and look at the numbers. But first let's start with the chapter and have some explanation. Let me lower my video. There we go. So chapter 10, commercial damages. We're going to see how to compute commercial damages. Next page. Now what I have highlighted here is that when someone damages another party, that party who was damaged in many cases is awarded compensation by the court. And what that amount should be is where accountants really come in. So forensic accountants can come in and help either the plaintiff side or the defense side compute damages for the loss. Next page. The next page is sort of review what we had in other chapters, so you can read that. And now let's get into some basics of litigation. Now, in order to win an award for damages, the injured party, in other words the plaintiff, must generally prove 2 points. Number one, that the other party was liable for the damage, so the other person's action caused damage to me, let's say, and that the injured party, me, actually suffered damages as a result of the actions or lack of actions of the offended party. Okay. Now, usually this requires proof of 3 issues. Proximate or direct cause. The damages caused were a direct result of the offending, and this is the defense, the defendant, the offending party's actions or lack of actions. Number 2, reasonable certainty. That it was reasonably certain that the injured party would have earned the claimed amount of damages but for the actions of the other party. Foreseeability. That a prudent person could look into the future and see that the actions of the offending party would damage the other party. So again, in general, going back to the top here, 2 points must be proved in court for an award for damages. The other party was liable, and the injured party actually suffered damages, due to the lack of actions of the other party. 3 issues must be proved: proximate cause, reasonable certainty, and foreseeability. Let's talk about 2 types of harm. There is tort and breach of contract. Now, the first type is tort. That's a harmful act itself. So an action took place by a party and it hurt the other party, right? So there was an actual action that took place. The second type of harm is breach of contract, where this could be called a failure of action. So it's the failure to fulfill one's contractual obligations. We had a contract. I did not do my part of the contract. Therefore, the other party, might sue me. Look at the next page. Now here there are 2 types of damages, right? Restitution and reliance. And you must understand these. So the first one here, reliance. Now, if reliance is found to be present, the plaintiff is restored to the same position as if the relationship with the defendant or the defendant's misrepresentation and resulting harm had not existed in the first place. Restitution. If this is found, then the plaintiff is compensated by the amount of the defendant's gain from the unlawful conduct, also called compensation for unjust enrichment, disgorgement of ill-gotten gains, or compensation for unbargained for benefits. Okay, let's look at a couple of examples here to explain these 2. First, restitution. If person A pays person B $10,000 for B to perform future services, and then later on B does not perform those agreed upon services, A will sue B for restitution, a return of the $10,000. Okay, so I gave someone $10,000. They were supposed to provide some kind of service. They did not. I sue them to get the money back. That's what this means. Now for reliance, let's look at this example. Person C signs a 5-year contract to rent a building from the landlord, person D. Then C spends $15,000 remodeling the building before taking occupancy. Now, if D, the landlord, does not allow C to take occupancy, C will sue D for $15,000 because C relied upon the lease contract in spending the $15,000. Okay, so you see that? This is the reliance. I relied on you in the contract. I spent money, maybe did not give money directly to you, but I spent money out the door. Then you did not live up to your end of the bargain, the contract. I'm suing you for this reliance. Okay. Next page. Now, what I have here, at least in these first parts here I've highlighted, we're finally getting into how do you compute damages, right? If you're called in on a case, whether on the plaintiff side or the defense side, you're presented a set of facts. You need to go through the facts and find out what you think, this is your opinion, what you think the amount of the damages are. So what you will do, like it says up here, expert use more than just historical data. So you're not just going to look on past accounting records, past income statements, balance sheets, past tax returns. You will use those, yes. But then what you'll need to do is make a prediction out into the future. So based on those past numbers, you'll need to predict what those numbers probably would have been without the action causing harm. You compare that to where the numbers are with the harm that actually took place, and that difference would be the amount of the loss. So how do you compute that? We're going to spend the rest of the chapter finding that out. So again, you're trying to, let's see in here, you look for your actual results, sales, profits, cost, market share. Then you predict, like I said earlier, you predict what that would have been without the harm taking place, right? And this gets into using your professional judgment, your experience, to find out what you believe, in your opinion, the revenues and the net income finally would have been without the action. Compare that, again, to what actually exists with the action that caused harm. Find the difference, and there is your loss. Accountants will disagree. That's why there are court cases. The plaintiff's accountant might have a large number, the defense accountant might have a smaller number. It's just the assumptions they used and the viewpoints they used, and there are differences. And that's where the judge and or jury comes in and decide whose numbers are correct, or is there an amount in between those numbers to be correct. Like it says here, courts tend to frown on damage estimates that seem to have little relevance to the facts. So if you, let's say, are working for the plaintiff side, and you try to create numbers that are just not relevant, they're just unreasonable, the courts will probably throw that out. So you need to make sure in any of your calculations, for both sides, plaintiffs or defense, you need to make sure you come up with a reasonable amount of money. Just a quick note here at the bottom. Like I said earlier, at the top of this page, you use historical numbers to then predict the future, right? What if it's a brand new company? What if it's just like a year old or less, or 2 years old? There's not much historical data to rely on. So there have been a couple of what they call new business rules over the past. There are two older ones here, up until 76, after 76, and then they have the modern new business rule effective in 2018. And what this is saying is that it's a new business. You don't have much background to go on. So you need to try to predict the future with not much history to go on, but your predictions will be looked at very, very closely. Just a couple of the first things here. Experts are held to a higher certainty standard for a new business than in cases with established businesses. An established business, you have years of background that you can build that trend line on. A new business, you don't. So whatever you come up with, it had better be reasonable. You're held to a higher standard. What this does, it improves the defense's strategies. Why? Because they're trying to say, no, the plaintiff's numbers are not correct. Look, they just made all this stuff up. It was a brand new company. How could they come up with such high numbers for loss of sales and net income, right? And so the others, you can read down through here. So very interesting looking at an old business with historical data compared to a new business with not much data to work with. Now we have several approaches that can be used. First, there's the out-of-pocket loss approach. This is used in California and New York. This refers to the difference between the actual value received and the actual value conveyed. There's the benefit of the bargain. In this one, the damages include not only the money invested, but other expenses such as increased cost, like interest expense, lost profits, and decreased value of the investment. Okay, so let's see if we can explain these with this example. So we had the out-of-pocket and benefit of the bargain. Here's the example. Deborah, the defendant, sells Paula, the plaintiff, an asset with an alleged value of $2 million. The selling price, $1.8 million. The asset really had a market value of only $1.6 million. Fraud damages can be calculated two different ways. The out-of-pocket approach in two states would say, well, the plaintiff really paid only $18 million, and it was worth, get this out of the way. Okay. And it was worth $1.6 million. You really only lost $200,000. You paid $1.8. It's worth $1.6. That's what you get out of it. Your award will be $200,000. If you're in a state where you can use the benefit of the bargain approach, you get more. It was put forward to you that it was worth $2 million. It's only worth $1.6. They don't even look to see how much you paid for it. But the person said it's worth $2 million. It's only worth $1.6. The amount of the award under the benefit of the bargain approach is $400,000. Okay. So just a quick explanation of out-of-pocket versus benefit of the bargain, and it might depend on which jurisdiction you reside in, or the plaintiff and defense resides in. Now, lost profits. How do we find lost profits? There's a before and after method. You take the plaintiff's profit before the act compared to the actual profit afterwards. Okay, that's used quite often. Very, very good approach. The yardstick or benchmark approach. You don't just look at the plaintiff's numbers. You compare the plaintiff to other companies in the same industry, and so you might then come up with a different amount. Again, if you believe this is the best method to use, maybe you don't have the data available for the before and after method, maybe you can use this method. So you're not just using the current company's numbers, you're looking at other companies in the same industry, how would they have done? And use that to then estimate what the damaged company's numbers would have been. There's a sales projection method, and you calculate lost profits based on relevant data, projecting sales with future growth assumptions applied to reasonable expenses. Okay, this to me is very close to the first one, before and after. I think they're very close. There's a direct method. If there's any kind of agreement that indicates here's the method you use, that's what you use. Then you can use a combination of any of these. That's why I said the sales projection method and the before and after method, I think, go hand in hand. So you can read a couple of highlights I have here. And you can read this one about the sales projection method. Let's look at what we have here. Figure 10.1, standard formula for damages. Now you have to remember, at a certain point in time you have the trial, and then the damages are awarded, right? If the defendant is found guilty and damages are assessed, awarded, that's a certain point in time. What you will need to do then is find out the earnings before trial. Again, you're after the time the damage took place, the action that caused the damage. So between that time and when trial is, you compare what the earnings were before trial. Had the harmful event not occurred, what would they have been? Take away actual earnings before the trial, plus prejudgment interest, and those are damages up to the point of trial. So the action took place maybe several years ago. You have to find out what are those damages up to trial, and then add interest. Then you might estimate damages out into the future. You might estimate 5 years, 10 years, or longer. What you'll do then is project what earnings would have been after trial, going out there into the future. Take away what the earnings actually were after trial. So there's the difference. You discount that. Use a discount rate we'll talk more about later. You're discounting that back to the present value up to the date of the trial. So you have damages before the trial, damages after the trial, and then you'll add them together, and those are the total damages. Okay, so again, remember, you have the trial date. Things are settled at that point, or awarded, let's say. Well, the harm occurred before the trial date, and it might continue to occur after the trial date. Okay. And you can read this bottom. Probably my screen is maybe covering part of that up, so you can read that on your own. As you start to compute the damage amounts, yes, you're going to look at the historical numbers you have available. You might go back 5 years, 7 years, 10 years, look and see what the sales were, the gross margin was, the net income was, and so forth over those years. But what you'll need to do also is see, for your trend line going forward, what's the overall economy looking like? That's the macro analysis. So if it's a great economy and had continued as a good economy, then your numbers would slant higher, as opposed to the economy suddenly went down sometime during the damage period. Second point, the industry. Now the industry itself, even though you might have a great economy going on, that particular industry might be nosing down or nosing upward more than the regular economy, the overall economy. So look and see how the industry is doing. That's going to help you predict those possible sales that were lost and so forth. Then you look at the company-specific analysis. And like I have highlighted down here, at this level, the forensic accountant may truly excel over other experts. This analysis includes scrutinizing the financial statements. Accountants know all about those. Includes the income statement, balance sheet, cash flows, and other statements and other documents. So you will really dig into the alleged damaged company's numbers. Look at those financial statements. If you don't have traditional financial statements, maybe it's a small business, they might only have tax returns. And that's fine, use tax returns if that's all you have. Because you'll have like an income statement on that 1120 or something. And then what you will do is, you're ready to draw a conclusion after you take into consideration these three: the overall economy, that industry, and then that specific company. Another judgment call you have to make as a forensic accountant doing this litigation support work is, what is the loss period? There is an action that happened. The plaintiff is saying, I was harmed by that action that this other person, the defendant, caused. You have to decide, well, how long was the damage period? So you have, maybe three outcomes, just to put it simply here. The first one here, let me scroll this down a little bit. There, scroll up a little bit. Here we go. Now in this one, this is an example of a damaged business with a total recovery of revenue. You have the trend line occurring before the action took place that caused the harm. T0 is where the harm occurred. Revenues dropped. But then at some point they started recovering and got past the point they would have been on this trend line. So they recovered completely. This is your time period of the losses. Is this 1 year, 5 year, 10 years? That's for you to come up with. Taking everything that you're considering and put it together, maybe you think, yes, they would have recovered after a certain amount of time. There's your time period for the loss. Okay? Let's look at this point. An example of a business damaged with continuing impairment of revenue. In other words, it never recovers. You have the trend line going before the action took place. Here's the action, T1. Caused harm, lost revenues, and then you're projecting, based on what you see with, again, analyzing everything you can, they will never recover back up to the line that they were on trend to hit. So it's continuous, way out into the future. And so you might go out 20, 30 years on this. Okay. The third point is damaged business no longer in existence. This is so bad, the action is so bad, the trend line drops to zero. They go out of business. That action was so severe, it caused this company to go out of business. And so you have a lot, again, indefinite period of time, and you really have to be using your experience and knowledge to estimate how long this company could have existed and the damages going forward. So consider your timeline. Is it a relatively short timeline? This continues. This is a complete loss, and of course continues indefinitely. That's what you get into. You project lost revenues, but your damage amount, it's very important to remember. Your damage amount will not be lost revenues. That's just the starting point. You really need to get down to, some people get down to net income. I like to consider cash flows, right? What's the actual cash impact? The cash impact is not lost revenue, because you would have had cost of goods sold, all these other expenses and so forth. So that's a starting point. Lost revenue is only a starting point. Now, forecasting revenues, as I just said here, is not the same thing as forecasting profitability. This gets into more net income or maybe cash flow and so forth. So it says true economic losses are lost incremental revenues minus lost incremental cost. Here are the revenues I would have had, but I would have had some cost to go along with those, and so that difference is really your loss. Another thing to look for, if you're on the defense side especially, is the mitigation and offsetting of profits. Now, a plaintiff who claims to be harmed must take actions that they can to mitigate, offset those losses. They cannot just stop everything and say, I was harmed, I can't earn any money. If they can earn more money, like in either another job or something, those are mitigating circumstances and damages, and those will take away from the overall damages. So you might have this amount, here's the damage amount, but the person could have worked and earned part of that back, see? Or could have taken some action and earned part of that back. So that's another thing to look for. So the opposite side of this, here are the damages, but here's how they could have mitigated or lowered those damages with the action the plaintiffs could have taken. So this is very, very important. Then time value money considerations. Again, my screen might be blocking this. Let me see if I can move it over here a little bit. Okay. And so in determining damage awards, consideration is given to economic loss that occurs prior to trial and after trial. So we saw those amounts earlier in those boxes, right? Damages before trial, after trial. And so you'll add interest on the damages before trial. Damages after trial, you'll bring all those back to a present value figure. That's what this is, time value money consideration. Components, the AICPA and CIMA publication list the following types of damages: lost profits, lost income, lost cash flows, lost revenues. But again, don't stop there. They lost the revenues. It really gets down to mainly profits, income, and cash flow. That's really loss, because you'll combine the last two, lost revenues and then incremental cost and expenses. Now, this is very, very important in communication. Let me go back one page. It starts, well, let me see, that's not where I want. Anyway, let's just go ahead and continue here. As an accountant, you're working with a lot of non-accountants, whether it's the attorney, the client, the attorney's client, the judge, the jurors. They're not accounting experts. So you'll need to be able to explain what you're doing and the accounting concepts the best way you can. Okay, so it's just so important to be able to communicate what that is. So hopefully I'm clear on this. You need to, like it says here, the ability to explain them to non-accounting experts. Whatever tools you're using, whatever assumptions you're using to come up with your opinion, you need to be able to explain that to non-accountants. Now, we have an example here, and this is where it gets a little bit detailed. So let's go through this a little bit slow. We have a one-year contract in effect for 2022, and it called for Lumber Supply Corporation to furnish 100,000 board feet per month of #1 grade red oak lumber to the Real Wood Furniture Company at a price of $2 per board foot, free on board destination. Now, lumber company satisfied the contract, the supply company, for the first 2 months and then defaulted. In other words, they were supposed to deliver the lumber for an entire year. They went 2 months and stopped. This was a contract. And so the Red Wood Furniture Company, the one that's going to be the plaintiff, is going to sue the supply company for damages for this contract that was not honored. Now the defendant will say, okay, let's find out what you could have gone and purchased that lumber someplace else for. And so the defendant's expert witness looks at other suppliers and to try to find out what could they have gone out quickly and bought that lumber that the plaintiff did not, the defendant did not supply the plaintiff with. Okay, so they said, all right, we start with March because we're already through February and January. It was delivered. The defendant's expert found out, look, you could have purchased the same board feet, same lumber at these prices. Yes, it's more than the $2 we agreed upon, and so you can sort of see what the damages are going to be, right? Like it's 10 cents per board foot for a couple of months and jumps up 25, 35, 30, 35 again. So let's see this calculation. Simple calculation. This is the contract price. Actual cost going out to buy somewhere else, we're talking 10,000 board feet per month. So find the difference. So 10 cents times $100,000. The damages for March, $10,000. You'll do that for each one of these. Let's take August. $2, the contract price. They could have maybe purchased at $2.40. So the 40 cents difference times 100,000, $40,000. Do it for all the months, add up, $270. So the defense's expert witness will say damages are $270,000. Okay, that looks sort of reasonable, right? All right. Let's see what the plaintiff will do. Well, the plaintiff might very well, we're going to see, actually goes further. What are the real damages? Maybe it's not just the difference between what I would have paid under the contract compared to what I could find on the outside. There could be other things. So let's see what they came up with. Now, in Table 10.4, we're going to compute the gross profit damages. Again, this is the plaintiff. You already saw the defense expert side of this. Now we're starting a whole new set of calculations for the plaintiff side. What they do is compare the actual monthly sales for 2021 in the previous year with the actual sales for 2022. Now the headings are not where they should be on top here. The actual monthly sales should be over 2021 and 2022. Average gross profit should be over here the last 2 years, and monthly over the damages. All right. So what they did is, all right, January, February, March, the actual 2022 sales are higher than last year. So there were really no damages. Probably on into March, they had the delivery from February and they were using that wood to produce items and make sales. So sales-wise, there wasn't damage at that point, not in March. Starts in April though. In April, sales were a lot less than last year. So they're saying, well, it would have been at least $500,000, we believe, in sales. It was only $350,000, a large drop off. We lost 35% as gross profit. Comes over here. Do the same for these months, comparing the actual during the damage period to the year before. And we have damages through, what is this, September. At that point, the sales pick up and they're more than last year, so they feel like that was not really a loss. It took them a while to find other suppliers, get the timber in, and finally get the sales caught up, right? So we have damages each of these years where the current year, the damage year sales were less than the previous year. Take that times the typical average gross profit, 35%. Here are the damages, so we're going to start here, $213,500. We're not going to stop here though. We're going to get into other costs, so make sure you read through this. It's a very good example. So in here they're saying we had to pay extra shipping to get this lumber from a new supplier to us. Under the contract, shipping was covered in the $2. So not only did they have a difference in price from March through December, just like the defense expert came up with, same dollar amount here, the actual cost per board foot, but they actually had to pay shipping. This is an actual cost the plaintiff had to pay. So now when we add the 10 cents difference between these first two columns, plus the 20 cents shipping per foot, 30 cents times $100,000, $30,000. We'll do that for each one. This comes up with $470,000. Now, when you compare this table back to a couple pages ago, let me just go back and show you that. Let's go back here and here. The defense's expert came up with $270 as the amount of the losses. Here's what the contract called for. Here's what it would cost you outside, $270. But if you add 20 cents for shipping that they actually had to pay for, it makes the loss go up $200,000. We're up to $470. So just something as small as 20 cents per board foot, you might think, well, I'm not going to worry about that. It adds up. This is where the forensic accountant in this litigation support area needs to be very, very detailed. Other costs in here. Now, they're looking at direct labor. Maybe because of the confusion with trying to find a new supplier, maybe the new wood purchased wasn't the same quality as the other wood under the contract. It might cause the workers to waste time just trying to use the wood and make the product. So they look at direct labor cost variances, and they find out that in several months here, the actual direct labor costs were higher than the standard called for. And so they're saying this was due to the damages under the contract. If they can attach that line of reasoning to this case, they can use this. So now they're going to say the direct labor cost variances were caused by the contract breach. So let's add these. We're adding these up. These are going to be cumulative. And the actual shipping cost, $270, and the expected shipping cost at the old rate, 12 cents. So you have to pay money to get your product, the plaintiff did, when they complete it to their customers. Maybe they had to expedite the shipping and so forth, so they had to get it out quicker, use different kind of shipping. Their actual cost of shipping was $270,000. That's not the same $270 we saw earlier. This is different. They had expected shipping would be $216. This $54,000 is another cost to consider. Advertising cost could be another. They had to advertise more. So the expert says that they had to increase advertising by $35,000 because they maybe had lost some sales and now they're trying to pick up the sales. So this, again, is damages. Make sure you come back and read this paragraph up in here and also this one. We can see that we had lost sales in 2022. We saw that earlier in another set of computations. Now, they believe they're also going to lose sales in 2023 and 2024. In fact, they talked to the marketing staff, and they believe that lost sales in 2022 are estimated to be 15% of the 2021 sales. So these are sales we didn't even have because of what took place. We believe we lost 15% of 2021 sales, the last actual year before the harm, and that was lost in 2022. We believe it's going to take us a while to catch up, that in 2023, going forward another year, lost sales are estimated to be 10% of the 2021 sales. Then they say, going into 2024, we still believe we're hurt, and 5% of the 2021 sales we have lost in 2024. So not only was there that 1 year, but maybe bad, due to customer complaints, ill will, so forth, they lost sales in 2022, 23, and 24. Let's look at what they're doing here. Oh, this chart at the bottom, let me scroll back down. So the actual 2021 sales, $6,230,000. Let's take that number for 2022 times 15%, then 10% and 5% for 2023 and 2024. They're saying these are our estimated lost sales. We really believe we lost these sales because of the breach of contract. Well, again, lost sales are really not damages themselves, but let's get down here to the gross margin. And so take these numbers, lost sales, times the gross margin over here, add them up, and so total lost profits 2022 to 2024, $654,150. Big number, okay? Let's get down. Here's what the plaintiff's expert then is going to come up with. Current year lost sales and gross profits, again just compared to the previous year, came from our first chart for the plaintiff, 213.5. Cost of buying the red oak lumber, remember the extra shipping cost is in here, $470. Labor cost, shipping cost to the customer, and advertising cost, they add to $620. The future lost profits, we just computed at the top of this page, add them all up, we're up to $1.487 million. So almost $1.5 million they're saying are the losses. Compare that to the defense's expert who came up with only $270. This happens very often. You have the plaintiff side saying, here are all the costs we lost, high numbers. The defense comes in and says, no, they're lower. It's up to the judge and or jury to decide who's right. This is where it gets into, can you explain your reasoning for all this? Are your numbers reasonable? Okay. So let's see what we have here. That's page about 18. And yeah, you can look at this testimony. We talked about that in earlier chapters also. And let's jump to, here's 19. Okay, so we're going to, jump to 24, I believe. We'll look at next. Almost there. And now, discounting after trial damages. What you're going to need to do, and again, this gets into a professional judgment call, is all those damages you predicted that will happen out into the future, you bring those back to present day dollars, a present value calculation. It's called discounting. And say, this is the amount that should be awarded today. The losses we think will be out in the future, but bring all those futures dollars back to today's dollars. That's what we're talking about right here. Now that discount rate, that can be a whole textbook all by itself. Okay, and so we will talk about that later. Now, discount rates, you look at what courts have said. Courts usually don't go above 20%. Okay, and you're trying to figure out what should be a valid discount rate to use. Will it be 7%, 9%, 19.4%? Each one's different. And you'll have to gain experience, do a lot of research yourself, go to these professional seminars to learn how can you come up with an appropriate discount rate to use to bring those future lost dollars back to today. I cannot give you one number that's going to work every time. It's up to you and your professional judgment. So there's a lot of reading behind this, a lot more understanding for you to come up with a discount rate to use. Communication. You must have great communication skills, not only in speaking to explain things to the judge and or jury. Your written skills need to be excellent as well. There are going to be various people going to read your documents, your reports that you might not have contact with. So make sure your written reports are just as clear as can be and convincing, and show that you're reasonable in your assumptions, and therefore your calculations are valid. So several pages on communication. And speaking, writing, and listening. Yes, listening. Listen to what your attorney you're working for is telling you. Listen to the attorney's client. Listen to the judge's question on the witness stand. Again, listening skills are also very, very important. Getting towards the end of the chapter, but again, whatever damages you come up with, they must be reasonable. It's just absolutely that they must be reasonable. The American Institute of Certified Public Accountants has a 108-page Forensic and Valuation Services Practice Aid titled Attaining Reasonable Certainty in Economic Damages Calculations. Get a copy of it, read it. Okay. They say there are 6 factors you can read here yourself that you need to consider, and other people will consider, to decide are your calculations reasonable, because if they're not, they're thrown out, and you don't want that to happen. They continue over here. So that's the end of the chapter. So again, sort of a detailed chapter, a lot of numbers. Go back and reread the chapter yourself. Go back in that example we had where we had the defense first putting forward a set of numbers. Then you had the plaintiff side, that expert witness, computing loss after loss after loss and adding them all up at the end. A good example. And so again, read the chapter yourself, and as always, good luck with your studies.